everybody, and welcome. Thank you so much for joining us for today's Unpuzzling webinar, Understanding Your Funding Options and What Investors Look For. We're thrilled to have such a strong turnout of food innovators. For those of you that I haven't met yet, my name is Marsha Druker, and I'm the Regional Innovation Director for Ontario here at CFIN, the Canadian Food Innovation Network. At CFIN, we fund transformative food tech projects, stimulate collaboration, and foster a growing community of food and beverage professionals. We've built the fastest growing and most engaged food business community in the country. Our core mission is simple. We help Canadian food and beverage companies reach their full potential by connecting them to new ideas, new technologies, and new opportunities that strengthen collaboration and position Canada as a global leader in food innovation. Today's session is a great example of that spirit. We know that for food tech founders, navigating the funding landscape can be confusing, and finding the right capital at the right time is often a make it or break it moment. So we've brought together a phenomenal group of experts, investors, lenders, and advisors to help unpack your opinions and share what they really look for when assessing startups in this space. You'll hear some honest insights, personal stories, and hopefully leave with a much clearer view of how to prepare for your next raise. So before we dive in, just a few quick housekeeping rules and things that you should be aware of. So first, we've launched a quick poll in the chat just to get a sense of who's joining us today. This is to help us understand who is here in this virtual room. So really appreciate you participating, and thanks in advance. We're going to save some time at the end for audience Q&A. But please feel free to submit your questions throughout the webinar using the Q&A box. When you submit your question, it's always helpful to note which panelist you would like to answer it, so take note of that as well. And we're going to do our best to get through as many questions as possible. All of our CFIN webinars offer real-time text-based translations in over 60 languages, including French. You can access the translations by clicking through the incoming shared link. And last but not least, our most commonly asked question, yes, the webinar is being recorded, so don't worry about scribbling down a ton of notes. You can always revisit it later. And I'd also like to take a quick moment to thank Fasken for sponsoring today's webinar. Fasken has been a tremendous partner in supporting Canada's food innovation ecosystem, and we're especially grateful to have Anne-Marie Naud, partner at Fasken and co-lead of their agri-food and agri-business group, here with us today as our moderator. So thank you again to Fasken for making this conversation possible. Now let's get started. I'm so excited to pass it over to Anne-Marie to lead us through today's discussion. Anne-Marie, welcome, and please share a little bit more about yourself and about Fasken.
Sure. So thank you very much, Marsha, and happy to be here today. I'm based in Quebec, so in advance, please apologize any misstep I do with my English, but I'll do my best today, and I'm sure that everybody will understand that I'm mostly a French-speaking person, but happy to speak English every day. So I'm a partner here at Fasken. Fasken is a law firm. Actually, we are based in every large city in Canada. So we have offices in Quebec City, Montreal, Toronto, Ottawa, Calgary, and Vancouver, as well as in Europe. So we're a large firm, and I'm leading a group of business lawyers in Quebec, but I'm also co-head of the agribusiness group that we have in our firm, which is a large group of professionals really interested in the agribusiness industry, from farm to table, but also agribusiness. And we also help very many startups in the food business, agribusiness. So we regroup 60 professionals who really know the industry and each aspects, which could be regulatory, which could be IP, as well as financing and corporate law. Myself, I'm mostly a corporate lawyer, transactional lawyer. And I'm also involved with startups and and we have a really specialized group of startup tech lawyers who could help, startups. And we do have special programs for any small company who would like to make sure that they do things well in order to reach out their first financing. So I'm really happy to be here today and share this next hour with our speakers, which I'll just introduce really quickly, and then I'll leave each of you just maybe introduce yourself and present exactly who you are and what you're interested in. So we have Doug Walker here, who's from who's an early stage investor, consultant, and advisor at N1 Ventures. Jasmin Ganie-Hobbs, manager, major accounts, technology industry at BDC. Megan Malone, director, business development at FCC, and Cam Crowder, general partner, Redstick Ventures. So maybe I'll just, pass along to each of you, and maybe you could go first, Doug, and just introduce yourself, what you're doing exactly, and what you're involved in.
Sure. Thanks, Anne-Marie, and hello, everyone. Great to be involved in this session today. So yes, as Anne-Marie mentioned, we're angel investors. So even though the name N1 sounds like a venture capital firm, it's actually two of us that are partners that are angel investors in early stage health and wellness companies. We are mainly targeting. We have done some tech investments, but really what makes us unique is my partner has a fairly large digital marketing agency. So we partner with health and wellness brands that are consumer facing. We can help with the marketing and brand building of those CPG brands. So that's really the types of companies we've been targeting recently. So yeah, we're really interested to meet founders and young, not necessarily young, but young companies and good innovators that are making some noise in this space. So thank you. Nice to meet everyone.
Yeah, maybe we can move along to Jasmin, if you could.
Thank you, Anne-Marie, and thank you for the introduction. Hello, everyone. I'm Jasmin Ganie-Hobbs. I'm with the Business Development Bank of Canada. For those of you who don't know us, we are certainly one of Canada's largest, most active and prolific investors and funders into the SME community. I'm on the technology financing team, extending debt, non-dilutive capital to companies, innovation, technology-based companies. Food tech is a very, very important segment to us, and we're certainly very happy to be here representing today. I have colleagues who sit on our equity and venture capital side, as well as our financing arm, and our advisory services is also a big piece of BDC's business. So we want to help our companies both by putting money into the companies and helping them with the right strategic expertise to help them grow. We work with other funders in the ecosystem, so we're not exclusive. We complement the other funders, and certainly looking forward to diving deeper into our subject matter today.
Sure. Well, thank you, Jasmin. And now Megan.
Hi, everyone. My name is Megan Malone, Director of Business Development with FCC Capital. I'll talk about FCC Capital in a second, but it is a division within FCC Farm Credit Canada. So we're a sister corporation to BDC, where Jasmin works. FCC is Canada's largest lender focused solely on agriculture and food. So we have a pretty sizable loan portfolio. 85% or so of that loan portfolio is Canadian farmers. And then the remaining of that loan portfolio is agribusiness and agri-food. So anything kind of before, on, and after the farm gate, all the way up into the storefront's door is really part of our loan portfolio. So that's been our primary book of business for about 60 or so years. And a year ago, we introduced FCC Capital. So FCC Capital is the equity arm of Farm Credit Canada. Under FCC Capital, we do direct investments into companies as of a year ago. We also are an investor in venture capital funds. So we have about 22 venture capital funds focused on agriculture and food investments primarily that we're an LP in. And we do other types of capital solutions now. We like to think them as maybe a little bit more stretchier debt lending than what FCC would have typically done. So similar to BDC, lots of different types of capital solutions for companies. But in our case, we're solely focused on the agriculture and food sector in Canada.
Well, thank you very much, Megan. It's really interesting to have, people, in all the aspects of the financing, and then maybe we can move to Cam, who really has another expertise. So this is really interesting. So Cam, I'll let you
Yeah.
introduce
Thanks, Anne-Marie, and thanks for everyone for joining. Cam Crowder, general partner of Redstick Ventures, also the co-founder of Redstick. We're early stage investors. We invest in highly scalable technologies across the food life cycle. So think like robots in farming to dynamic pricing in restaurants. We'll do anything across that. Currently 13 portfolio companies. And we like to think that we punch like above our check size. So we really come in and support the founders and the founding team because we have operational angle as both the founders of the firm. So we can kind of, talk about, scaling teams, scaling technology, things like that. So really excited to be here today.
So thank you very much, and we'll move along to our next topic and first topic, which is kind of overview of funding options for food tech startups. So maybe I'll ask each of you, and I do have some questions, but to share success stories and standout example of coming out from your portfolio or experience or client base. So maybe I'll start with Megan, and please, each of you don't hesitate to jump into the conversation. That would be really nice. So Megan, maybe we can start with you. And so what role does FCC play in financing innovative food businesses, and how it is offering different from that, how is the offering different from traditional bank loans? So, because for sure, and as you said, from the onset, FCC, we think of FCC with debt, but we know that now you're more diversified and you can just, as you said, stretch a bit the offer. So this is really interesting.
Yeah, I would say, so as I alluded to earlier, there's a few different types of capital that we can deploy to companies through FCC. But I would say what sets us apart, again, is really that niche of being Canada's largest lender solely focused on food and ag. So what that allows us to do is come into these opportunities with unique sector expertise and some history in the industry, if you will. Being a Crown corporation, so our only shareholder is the Government of Canada. While we are a Crown Corp, we are a fully self-financing Crown Corp. So we are profitable in our own right and use those profits to run our business. But I say that because it's an important point in that we have a very solid balance sheet to work from, which is what's allowed us to have this new equity arm under FCC Capital. And so having a balance sheet that we can lean on and some profitability that we can work with allows us to also be a little bit more of a patient partner for companies. So I would say for a few reasons, we can come into these opportunities with some expertise. We come in with connections and advisory solutions, not just the capital. And then we also don't have, we're lucky in comparison to a couple of my colleagues on the panel here today, where we don't actually have to return capital from an investment to other investors, if you will, within a certain period of time. So we can be a little bit more patient in the types of financing structures that we can put in place and the types of equity that we invest into companies. I would say in terms of financing, like innovative business models specifically for food tech, it's not necessarily specifically for food tech, but for companies that fall into the FCC wheelhouse. Naturally, now that we do have the ability to make direct investments, we can do direct investing, and then we can also come in afterwards with some debt financing. Sure. So it does allow us to do a bit more of a flexible capital structure for companies that might need different types of capital for different parts of their business. Maybe I'll pause there.
Okay, thanks. So well, thinking of FCC, and then we're moving to BDC, which is also, in my mind, a Crown corporation. So maybe Jasmin, how would your offer be different, and how does government-backed financing like BDC loans support food tech innovators? And at what point should we contact BDC or some other lender or investor? So that this is the question I
Sure.
have for you. Yeah.
And Anne-Marie, you're right. We are a Crown corporation, so our shareholder is Government of Canada. And that being said, as I mentioned earlier, we don't tend to see our offerings as, oh, should you go with BDC? Should you go with FCC? Should you go with somebody else? The way we see ourselves is one partner that will likely be a very good partner to have over and over again as you capitalize the company, but that's alongside everybody else. So we can finance with angel investors, with venture capitalists, with FCC, with other banks. And so it's not either or. When should you contact BDC? It's likely as you're getting to the point where a company is generating revenue, ready to generate revenue, or has been generating revenue. So in our group, on the technology financing team, typically, oftentimes we are coming into a company as early as the first year of revenue generation and anything beyond that. So if a company is in R&D mode and they're going to be there for the next 24 months, that's not likely something we can finance with debt. But if a company is at market, they've had a few months of sales, they need additional capital to grow, to do marketing, to hire people. There's nothing that we can't finance. So all legitimate business purposes are potentially financeable under our loan offerings. But we do expect the company to be in market, commercializing, and money could have been raised from any of the parties at the table here or others. So it's oftentimes we are first to the table with debt, often. So, but however, that being said, even if we're first, we're happy to accommodate other lenders as they come to the table and equity partners as well. So, and the way a company should, as I said, think about this is really over the long term. So it's not a transactional relationship. It's not one time. It's we hope that if the relationship goes right, we will grow with you as you grow. And as you become a bigger company, we'll become a bigger funder to the company and extend more capital. And that's the intent of the relationship. We want to get to know you on the first round of funding and hopefully come back again.
Okay, thank you very much. That's really interesting. And now maybe we're moving to more like the angel investors as well as the VC that Cam is. So Doug, I'll just ask you a question, learning what we're learning now in terms of debt and when we go to FCC or BDC, but you come in as an angel investing for early stage food tech startups. So when what are the pros and cons, and when should we reach out to you?
Yeah, sure. I mean, debt and equity have their advantages and disadvantages, and often when you're just starting, you don't have access to debt right away, or you don't want to take it on. So yeah, as angel investors, typically, come in pretty early, and that I guess the advantage over more institutional investors is we can get involved before you have too much traction. So an institutional investor may be looking for pretty significant, repeatable sales track record.
Yeah.
They may have a minimum check size that's a little too big for what you're looking for. They might be looking for a little too much of your company right away. And Cam will give the other side of this, but we come in early. Usually angel investors are investing in an area where they have some expertise or interest, so can add some value, either their expertise, their network, their skill set. And and are there to help but not control, right? Like usually this is not a full time, a lot of angel investors are not doing working on their investments all the time, right? So it's just kind of.
But you do bring expertise, right? Typically,
Absolutely,
and experience, right?
Yeah. And I'm involved in a couple of big angel groups in Toronto and the West End, Oakville, Burlington, and a lot of the angel investors are, very impressive, people that have sold their companies or retired doctors or scientists or things. So there's a lot of expertise that the community can bring. Just your question. So there's a lot of advantages. The cons, I guess, would be you are giving up equity. So you're giving up a piece of your company pretty early on. Typically, that's what angels would be looking for. Limited capacity. So usually angels may or may not be able to follow into the bigger rounds. That's where the institutional investors get involved. And you have to be a little careful about an angel because you're not sure they're vetting. So there could be quite a variety of sophistication. So if you get involved with the angel that doesn't have the right experience in
Yeah.
investing, maybe they want to get too involved in your company or they're not adding a lot of value. So there's a little bit of more vetting on your part than maybe with the VC. But yeah, so that's kind of the slice of the industry that we provide.
Okay, thank you. That's very interesting. So, then you have this mentorship, that relationship that could be really helpful too if you find a good fit, right, with the company.
Exactly.
So Cam, moving to you, so same kind of question, when does private equity or VC funding make the most sense for food tech startups? And, I recall our rehearsal and you had a really interesting answer to that. So
Yeah. Well, usually like when people ask, like I tell them don't take it. That's sort of where it starts, right? But yeah, I think there's like three main things that we look for. You're looking for a company that's in like a ginormous market, right? And like a VC is looking for your company to get to 100 million in revenue, like in a really like back envelope way. So it takes a while to get to that point, like we're looking at like 5 to 10 years sort of to get to that point, but we want to see a high growth startup. There may be some scenarios where you had like a heavy R&D type of company that's very capital intensive in the beginning stages. Like think of like a robotic startup or like precision fermentation, something like that, where you need to get over the hump and have enough capital to get there. And you're typically like, we're going to look for like a really high level technical person to fund that type of company. And then the other one, like with AI being so like prevalent right now, is like this idea of like a land grab where you've kind of got, an idea early that could be, supercharged by AI that you need a lot of money to market it quickly. But one thing that I think gets missed a lot of times is like how VCs look at making investments. And Megan kind of touched on it, is like we have investors that give us money and we have to look at a certain level of return for the risk that the investors put into us, right? So typically we're looking at like a 10 to 20x type of return on our initial investment that goes into a company.
yeah.
So it's not like for everyone to take VC money, but certain types of companies do really well if they get a type of financing like what we could provide or other venture firms.
Okay, so thank you very much. If you have anything to add to one or the other, but this is really interesting. So high growth in terms of VC, and then you may have some more patient investor depending on, if I move to FCC. So this is really interesting. So we see that there are some solutions and there are some options that, the startups can look at depending on exactly what are your intentions and what are your goals and, how the growth is looking in the future, but this is really interesting. So we'll move to our next topic, is like what investor and funders look for in food tech startups. So I'll start with Doug. So what are the key factors you prioritize when evaluating food tech startups? So especially those in technologies, new technologies or products. So what are you looking for exactly? Because we know that we are at the onset, so just to make sure that we all on the same page to that.
Yeah, I'm glad to go first because I suspect
Yeah.
we have a lot of the same criteria here.
I
But
can imagine.
it always starts with the founder. So a founder with some obviously the skill set and expertise in their area, but with a passion and a flexibility, right? So ability to adapt and take input from their advisors and their investors. That's number one. The product, it needs to be pretty outstandingly unique and differentiated. There's just so much competition in food and tech. And it needs to be defensible, right? So whether you're able to protect it legally with a patent or a trademark, or whether you have something unique, some unique control of your supply chain or something like that to really be defensible from, because as Cam said, with AI, there's a lot of ability to quickly copy and build
Sure.
on people's previous ideas. So I would say, that it's traction. So I think every investor is going to want to see some traction, some sort of repeatable growth. It doesn't have to be years and years, but moving in the right direction, you're growing, and it's not just one-off revenue, it's repeatable revenue. It doesn't, not just revenue, but you have early pilots, or you have a big first commercial customer that's working through your solution for you. Those are all important things. Yeah, and I think there's many other things, but it's really the founder, the product, and the uniqueness of their solution. So that would be the main points we'd be looking for.
Yeah. So I think, this is a kind of a general answer, but then maybe I'll move to Cam, with this other question is, why do you believe some funders should take more equity early? And we've talked about it. And what specific signals do you look for in early stage food tech startups? You said that you're looking for growth and rapid growth, but is there anything in terms of other? Yeah, go.
On the dilution side early, like I think a lot of founders make this mistake, especially in food tech and like hardware type companies where they're protecting their equity position, which I understand, but I think like early on, and you listen to Megan and Jasmin talk about their kind of finance offerings and debt and equity, like it's better off to take the dilution early in the first couple of rounds, in my opinion, as a hardware startup or a food tech startup, because you can leverage debt later on, right? Where if you're a software company, it's a little bit more difficult to do that. So the first part of that is like, I really think that like getting the money in the door quickly and
even if the value is kind of low,
it's a little bit, it's a little bit self-serving for me as an early stage investor to say that, obviously, but no, I think it's the right thing to do. If I was a CEO of a company, that's what I would do. I would make sure I had the money in and I could get to that next stage and hit my KPIs. And then on the like, what are we looking for? Doug kind of touched on it a little bit. Like, we're early stage investors. Typically, the company's going to pivot a couple times. Like, it's a people bet for the most part. We're looking for someone that typically is like trying to solve their own problem. They have like industry experience. But I think the one thing that I really kind of like look for is that kind of like I should be reevaluating my life if I'm sitting in front of like Jeff Bezos or Steve Jobs or someone like this, and they're asking me to join their company for an investment. I should have that feeling in my stomach, like I should quit everything I have going on to join this person, right? And there's really like a couple of reasons why I kind of like think that way. And you're going to need to get capital in your business as a CEO, right? Of a company that's going to take venture capital. You're going to need to convince people to quit their jobs, like really high level people, to take a pay cut and quit their jobs to join something that has a very high failure rate. And you're going to need to attract customers, right? So I want to see a level of pervasiveness of like kind of like I need to join what they're doing, right? And get that first pull towards it. And I think those people end up succeeding in this industry. So yeah, those are kind of like the main key points.
So maybe I could add some passion into these people, just to make sure that they are convincing and that, as you said, you want to get on their bus and
totally
to the ride, right? That's really important. And that's, I was at a CFIN meeting a couple of weeks ago, and that's what I found in the room. There was about 100 persons who made it out to Montreal downtown at 5 o'clock. It was 30 degrees out there outside, and I was pretty amazed to see lots of passion into the CFIN members who joined for the event. So I'm sure that the people who are here today do just fit the purpose and could be people you will be happy to discuss with. So maybe moving to Jasmin, what are the most important indicators of startups' readiness and ability to repay financing?
Well, to repeat what Doug said, so some initial traction. Everybody's looking for some initial traction. And also we want to, beyond that, what we do want to see is that there's some controls in place. And by that, I mean financial controls, and that the books are in order, financials are in order, plan is in order. So for, they're basic things, but I can tell you more often than not that we see companies who come in and do not have every aspect of what's needed for initial due diligence in order. Financial statements are not done. The plan is not complete. The projections are not accurate for the type of lender or funder that you're in front of, and all those things need to be tweaked. So, just taking something, for example, as financial projections, what you might use for an equity funder, you would not use for a debt funder is completely different. Not having your cash flow projections complete with or without various funding scenarios. So these are basic things that we're often coaching. Our team is spending a lot of time coaching on that.
And you do offer coaching, don't you? Or
we certainly do offer coaching, and we can help with certain things. So there are certain things that we can help with, certain things that we can't help with. If it's directly related to our financing, we would not be able to do it. Like, for example, if it's a financial projection that may or may not get you one of our loans, it's a little bit too close, so we would not work on a financial projection that one of our lenders might see. So we would expect a company to at least have those in good order. Without those sorts of basic things, we cannot do anything at the moment. So I would say just make sure that all of the controls and the processes and things that your funders are going to look for are in complete order. We're looking for them, and just knowing who does what as well. If a funder is providing $150,000 startup loans, no point in walking through the door and asking for a $10 million first check. That's not what they do, and that happens all the time. So some due diligence and research would get a company far as well.
Okay, great. Thank you very much for that. And Megan, maybe just moving to you, what are the red flags that you see in funding applications, and how can startups proactively address those challenges? So what should we be aware of in terms of?
Yeah, I would say my panelists all here have kind of alluded to the ones that I would think about. It's just, when Jasmin was just saying, know who you're approaching and what they're looking for. So, we've heard from two investors here a little bit earlier stage, and what's important to them. They want to know about the founder, and they want to know about, like, what are you bringing to the table? What is your defensible moat for your company? What is it that you built? Have you supported it by IP if it is IPable? Do you know what your go-to-market strategy is, how you're going to sell whatever it is that you're selling, and who your kind of market is that you're selling to? Is it big enough? Is it interesting enough for those investors? When you're coming, as Jasmin said, when you're coming to a debt lender, do you have the right financial information in place? Like, do you have good financials? And if not, then can you go get maybe a virtual CFO or an interim CFO that can help you build those financial models? There's quite a few resources now that companies can tap into in terms of part-time CFOs or support for that matter. And then as you're looking at maybe a little bit further down on the financing spectrum, if you need projections. So prior to joining FCC, I did about 2 years as a banker in the software industry, so lending to software companies. As we know, software companies don't have the traditional, accounts receivable and inventory that a bank would typically lend against. And so when you're doing SaaS-based lending, software as a service-based lending, those financial projections matter a lot, because that's really what you're getting your SaaS metrics from and kind of modeling your financing around. So again, like, having all of those things in place is really important. And if a company can't really come to those discussions with the right documentation in place or the right answers to, say, investors' questions, then it does create a bit of a red flag on readiness. What I would say in terms of how can startups proactively kind of address these challenges is, like I said, reach out to resources. There's lots of good stuff out there. We talk a lot about artificial intelligence, but ChatGPT is pretty intelligent in a lot of these categories too, and telling you, what do investors want to see? What do banks typically look for? How do, so on and so forth. Not that that's the only one out there, but it's probably the one that we're most familiar with. And then the last thing that I would say is just, there's lots of good programs out there. I was just chatting with an early stage startup that we are indirectly invested in through one of the venture capital funds that we support. And That early stage founder was saying, he has a scientific background, so like very, very intelligent in the scientific part of the business, can completely like nerd out in the lab, so on and so forth, but really didn't have the business piece figured out. And so one of the things that he said that had really helped him was going through accelerator programs. He went through a couple of different accelerator programs, but there was one specifically where he said they really taught, like, how do you think about your go-to-market strategy? How do you build a good business model? And then, how do you kind of action that model thereafter? So doing a bit of research in terms of, what are different programs or accelerators or resources that you can tap into, and do those before you start approaching the.
This is really interesting, and these resources are there, so it's there to as CIFIN is really helpful to many startups, and we have people today, but this is really important to make sure that you do your homeworks and make sure that you do understand the business sense when you have this passion with this great idea, but sometimes then you'll need to have the discussion with business people and you'll have to speak the language, right? So this is, well, thank you very much. So I'm moving to the other topic that we have, the legal and strategic preparation before raising capital. And I'm the one who will start with on the legal side. So I just want to speak a bit about the most common legal pitfalls or gaps that we see when founders are preparing to raise. So it is really important in terms of legal matters just to maybe also understand the legal landscape that your business is into, and also the corporate background, and make sure that everything is in order and your ducks are in a row in order to be prepared to your first due diligence on the legal side. And I think of things that are not, and sometimes we think that, people think it's really expensive and it's not their, priority to address the legal matters. But even on the corporate side, just to make sure that you have, a good understanding of your capital structure, of your corporate structure, how it works, who is doing what in terms of shareholders, in terms of directors, in terms of officers. These are really sometimes really simple questions, but you find at some point that people, are mixed, and even, in terms of assets, which assets are in the company and which assets are the founder's assets. And at some points, when we get to a financing, we just need to figure out who owns what and everything, because, founders have mixed up their own assets with the company's assets. And, there's lots of the due diligence, just raises all of these questions. So lots of preparation and maybe a bit of investment. And I think, pretty quickly, and maybe Doug, you'll agree with that, I think it's a super important investment to make sure that you will be able to protect your brand. If you're in the food tech industry or food industry, and you will need to market your products under a brand, and if at some point you haven't even searched, if the trademark will be available and you'll be able to use it moving forward, then, and I've had to accompany some clients who had to change their names after a year or two of operation, and this can cause lots of damages in terms of reputation. So this is really important. And also, when you're in the tech industry, you also need to, when you hire people, just to make sure that everybody who's involved in the R&D, the inventors, and those people developing the IP, make sure that they do assign any IP rights that they may have, or, even if they've worked at night or during weekends on technologies that at some point could have been brought into your products, you need to make sure that, all these rights have been assigned to the corporation. We do have lots of issues because at some point, these people were employees, they've left. You need to chase them, when you're about to raise the capital, and 2 days, before closing, it's not the right time to chase someone for a signature that was missing on an IP or confidentiality NDA agreement. So these things need to be in order. We do have, like my firm, we do have some programs, perfectly customized for startups to help you prepare all the documents ahead of a capital raise. So this is really important to my sense. maybe I'll just pass, the question to Cam in terms of strategic preparation. What mistakes do you see most of the time in early fundraising rounds?
Yeah, I mean, I'm going to stay away from like the Y Combinator type of pitch deck where it's like drawn with a crayon and then they say, give me $5 million at a 30 million valuation, right? That's kind of a different sort of thing. But yeah, like we're trying to identify a needle in a haystack, right? So to give some context, like we've looked at 950 deals over the life of our fund and we've made 13 investments, right? So we're pretty much looking at like every opportunity to say no, right? So when we dive into a half-baked data room that has like spelling mistakes and, you've only got like a half, Megan made a great example, like hire a CFO to do a good financial model because we want to look at the financial model to understand what the business is going to look like in a year, 2 years, 3 years down the line, and how much capital you're going to need to raise and how much dilution we're going to take once we come in. So like get a fractional CFO, make sure that there's lots of resources online to understand like what things you need in a data room, make sure everything's there and accessible, and don't like kind of like add things as it comes, like have it all in one shot. I think the other thing that a lot of founders make the mistake of is and it's hard to do, but raising money while they're building their business. When you're raising money, it's a process, and you should be hyper focused as a CEO of raising money because you're going to need to talk to a lot of people. So like for us, like as a first-time venture fund, we have 30 LPs. We needed to talk to 450 investors to get those 30 LPs, right? So it's a very similar type of game when you're raising money for a startup. Like it's a process, get your list together of who could be potentials, talk to those people, be hyper focused on it, follow up with them. Those are kind of the things that I think get missed a lot of times. And you're going to need to have 3, 4, maybe 5 conversations with a venture firm, especially if they're leading your deal. So just be prepared for like a level of like in-depth due diligence that'll happen. But those would be kind of like the main things that I come across.
Great, thank you very much. Jasmin, what should be included in a strong funding package? Because you do see lots of application. So from a lender's perspective, what are the most important documents that you would like to see there?
Well, from a debt funder's perspective, what we're looking for, the basics are your last year's financial statements, accountant prepared, interims for this year, at least a 2-year financial projection, a thorough business plan with an executive summary, and that would a cap table. What does your cap table look like? So I think those are the basic starting pieces of information. So all too often, as I mentioned previously, these things are not all together. Things like having the accountant prepared financial statements and other information that are to us, it's how are we to assess the finances of a business without having financial statements, both what is happening now. A summary of the pipeline is also great. We would love to take a look at that. Who's in your pipeline? Where is it at? And anything else that may be deemed relevant. It could be IP, pending IP, so things like that, and also a summary of your board if you have one or are putting together one, and so we know who are the players at the table. What kind of support does the company have?
And maybe on the legal side, this is something very interesting. I just had some working session with, either board of directors that should come early in the process, but also you could, just have set up an advisory committee, when you're a startup. So you just make sure that you have people that you can reach out for any questions. And that's something that we suggest, early in the life of a startup, just to make sure that people do have people and sounding boards. And so Megan, maybe one last question to you, and then we'll move to the other questions. But what role do FCC's advisory services or mentorship programs play in helping businesses get investment ready? I know that you do have programs, but this is if you can tell us about it.
Yeah, so my role specifically, I know my title is business development, but a big part of what we do on the FCC capital side is we don't necessarily want to make an investment into a company unless we can create value for them beyond that capital. So what we mean by that is being the largest lender and financer of ag and food in Canada. We know that we have a lot of resources and we have a lot of connections and relationships, and so we can be quite a bit more useful beyond that financing in a number of different ways in terms of tapping into knowledge and our vast network of partners. On the advisory side, we do have advisory within FCC, but it's really for transitioning farmers. So if they're, getting ready to maybe retire and they're looking to transition their farm into family members or another individual, then that's really what that FCC advisory service is for. But when we think about the FCC capital and our portfolio companies, I often refer them to, we have a partnership with other advisory firms. So we have one specifically called IC Canada Innocent. They, unfortunately, I believe only work with government partners. So you need to either be an IRAP, NRC IRAP, FCC, or I think it might be an Investissement Quebec or something like that can refer you into IC Canada. However, there's many other advisory organizations like them that can work with companies. And so typically that's, for example, we have some companies or opportunities right now, especially with the current landscape in Canada, where we're looking to bring, a lot of processing back to Canada, because naturally that was being done in the United States, and now those opportunities are changing. And so we have opportunities in Canada to bring, food processing back here, but a lot of the, let's call it the individuals that were supplying the raw produce to the US to be processed, they're looking to bring that processing back here, but they don't necessarily have that expertise around what does it mean to process the raw produce, if you will. And so in order to become investment ready, we need them to have, like we've discussed, a business model, a financial model, and all of these things. And so those are opportunities that if we're looking to potentially participate in supporting, that specific transaction, we might refer them to our advisory partners so that they can help them build the business model, the financial model, and then come back to us when that's kind of in place and there's like an investable opportunity, if you will. The last thing that I will say, and I know there's quite a bit of discussion in the chat, I've been seeing them pop up around accelerator programs. So I'll just speak to that for a second, because that really is, I would say, a good starting point for companies in terms of getting the type of advice that you might need. And different accelerator programs offer different support. So the ones that, FCC currently supports is through financing is SVG Thrive. I saw that mentioned in the chat. So SVG Thrive is solely focused on agri-food. There's also Foresight Agri-Next. There's CDL, Creative Destruction Lab. They have a number of different streams, but we support their agri-food stream. The last one that's in the ag network that we support right now is Cultivator. But there's so many more. And so it's really understanding, what is the type of support that you need. From my understanding, companies get a lot of success out of CDL when they need mentorship at different levels and from different kind of people, if you will. That is really CDL's structure, is to go through kind of these advisory and mentors throughout your stage of your time with that cohort. Whereas SVG Thrive is really known for having, a large international network and some corporate partners that are plugged into them. So if you're really looking to kind of scale your business, get plugged into different corporate opportunities to sell to larger companies, if you will, then maybe SVG Thrive is something to look at. So again, it's just doing a little bit of research and figuring out what those different programs are, but there's lots of support out there. So.
Well, thank you very much. Unless any of the panelists would like to add something, I'll just, we'll move to the questions, because there are so many questions in the chat that I think that are super interesting. So Marsha, maybe I'll leave it to you.
I'm so excited to see just the number of questions that we got from this session. I think this is a new record for us. So that's amazing to see. We'll try to do these kind of lightning round to get through as many as possible. And I think we'll be doing some follow-up content on this as well. There's some really great questions that we can answer in a blog post or something like that. So I'm going to jump to the first question from Kieran. How much time do you need to dedicate to the actual capital raising process? For example, meeting with potential investors. Are roadshows done in person or virtually? And is this coordinated by the founder, or are there early stage IBs that can set up the meetings?
I can take that one. Yeah, like, I mean, you take as much time as it takes, I guess, if you're the CEO of and founder of a company and you need $1 million, like your company needs $1 million, like you shouldn't raise more money than that. You shouldn't raise less money than that. I think right now, like Zoom's a great way to do like a ton of meetings where you can pack your calendar in a condensed amount of time versus like, go and see Megan in Ottawa, go to Toronto. Like you don't need to do that, I don't think anymore. Now, if you have some very scientific hardware type of deal, like then someone may want to come and see the technology, but yeah, as much time as it takes, you know.
Perfect. Okay. A couple of questions for Megan here that are related. At FCC, when or what criteria would you look to access capital in the Ag Tech Fund versus direct with FCC? And then also a follow-up question to that is what stage would FCC be looking at investment in a food tech startup, in a food startup? Yeah.
Okay, I'll just clarify one thing because I think I saw that ag tech question, like ag tech fund question. So the one clarification is that FCC Capital ourselves do not necessarily have a fund of our own. We just have a pool of funds that we are deploying or dispersing, if you will. But we are directly, like we do invest, we're a limited partner in about 22 different venture capital funds. So I think that question said NIA. So NIA is the 51 Agri-Food Fund, which is one of the venture capital funds that FCC is an LP in. The full list of those funds is on our website. If you just Google FCC Capital and you'll come to fund investments, you'll see the full list of all the funds that we are a limited partner in. And so each of those funds have their own criteria, of course. And so if we think about FCC as a direct equity investor as of, just several months ago, our criteria is we are not leading on any rounds. So you do need to have a lead investor secured for your equity round in order for FCC to come in. And then number two is that we're actually investing a little bit later stage, and I will explain why. There is a big funding gap when you kind of get to that mid to later stage equity, especially in the food sector, actually, because it's a capital intensive industry. So there's a lot of capital required for a lot of food and food processing and food tech companies. And that's kind of where investors need to start seeing their returns, is once companies get to that midpoint, investors are starting to look to see some returns. And that's really where that patient capital needs to start coming in bigger chunks. So we tend to have our minimum investment of 5 million Canadian dollars. I say that with an asterisk because there's always some exceptions. We do have a bit of funds earmarked for smaller investments, but typically we are looking for a lead investor and FCC to be putting in a minimum of 5 million when we're talking about direct equity. On the debt side of things, there's a number of different criteria that we can talk about there, but typically companies need to at least be generating revenue in order to be considered for the different debt solutions that FCC has. The last thing I'll say on that is that if you don't fit our direct equity criteria, I do send a monthly email to our investor network. It's over 100 investors right now that have opted in to receive this email. It's called Capital Connections. And that email is any companies in the Canadian ag and food ecosystem that are actively raising capital, typically equity, And so that will get you in front of a wide investor network of anywhere from angels to family offices to venture capitalists. So you can appear once on that list. We try to give, well, we do give investors on the list new names each month to take a look at.
That's excellent. Great tip. Question here from Rajveer. How much equity do you have to give up in your company for a viable trade-off for angel investors versus VC funding?
Well, I guess I'm the angel guy. So
You're the angel.
yeah, there's no hard answer to this, but let's just say typically could anywhere from a couple of points, like a couple percentage to, I don't think an angel would want to get, I don't think you'd want to be giving up much more than 15 or 20% to an angel early. So somewhere in there. But typical, like a lot of the deals are more like 5 to 10%, at the most. So yeah, and because you're probably not just doing it with one angel, right? You have a couple, so or we're putting it together a small syndicate. So all that together at that stage, I don't think you're probably looking to give up too much more than say 20% of the company. So, but it depends on so many things: your valuation, the stage you're at, your the speed you're trying to grow at, all those sorts of things. But Cam could probably speak more to a little bit further down the path percentages, but it's not too big at the angel stage.
Yeah.
Yeah, like 10 to 15% typically, sometimes 20.
At
Great.
the most, right? Okay.
Yeah.
Yeah, thank you both. So this next question I'll throw over to Jasmin, and then Megan, if you want to jump in as well. What is the maximum covenant EBITDA you will lend against for a CPG company?
We don't have a technical maximum, so there is we're looked at on a case-by-case basis. So instead of giving you something that's out of one of our textbooks, so to speak, or virtual books, come see us, chat with us, and we'll be sure to give you more detailed information on that.
My answer is the same. I actually have no idea if
Awesome.
that's part of the process of, I would say that would be maybe our strategic finance team, which is our new debt lending team under FCC Capital, but TBD.
Yeah, makes sense. All right, another question for Cam here. What is the criteria in terms of traction for an investment and for access to take out strategic or otherwise to help with the exit?
Yeah, so traction's like an interesting thing at the early stage. So there can be a lot of signals that it could be like a technical moat where you've got this technical breakthrough. It could be obviously sales and revenue that you've got customers. It could be EOIs, LOIs. It could be getting funding from CFIN through one of the non-dilutive arms. There's a lot of different ways to do it. And then what was the second part of the question, Marsha?
Let me pull it up again. So the second part, so what is the criteria in terms of traction
for exits.
Yeah, for
exits,
exit,
yeah.
yes.
Yeah, obviously like there's like kind of two routes to exit really, right? There's like you build your company big enough that you have an IPO and you exit in the public markets, or you get taken out in the M&A markets, right? So there's kind of two different paths. We like to position ourselves of like going to the corporations. So we work with like Post Holdings, Tim Hortons, McDonald's, RBI, a bunch of like bigger brands, and like look for what their problems are. So we try to like make investments like looking for the exit before we actually make the investment, and then nurture the relationship with those potential acquirers as the company matures. But typically, like you're going to need to get to like and this isn't like a cookie cutter standard, but like let's say 1 million in EBITDA, so that it becomes like attractive for an acquirer to pick you up, and it's not going to cost them money year over year to invest into your technology. You're going to want to see that your company's kind of like stabilized from a fundraising perspective. But again, it's not cookie cutter. It could be like a bunch of different like ways of why a company would buy you, right? So yeah, that's
Yeah.
that's about it.
Perfect. So we are at time. I can't believe how quickly this hour flew by. Just shows how much demand there is for this topic and how many great questions there were. So yeah, I just wanted to say thank you so much to all of our panelists for the incredibly thoughtful and candid discussion today, and to everybody in the audience for joining us and for bringing such fantastic questions. We really hope that you're walking away with practical insights on the funding landscape and a clearer sense of how investors and lenders think, and maybe even a few ideas to help move your business forward. So before we wrap up, just a couple quick things I wanted to plug and share. So our next Unpuzzling webinar is happening on Thursday, July 10th. And the topic is sustainability in food, practices and progress. We're going to drop the link to register in the chat, and you could find it on our website as well. I also wanted to share an exciting new program that we have called Food Tech Frontier. So if you're part of a Canadian food tech company doing standout work, or you know somebody who is, you don't want to miss this one. It's a brand new program that recognizes 25 of the most promising and innovative food tech companies across the country. Applications are open now, and it's an amazing opportunity to get national exposure and to join a network of trailblazers who are shaping the future of food. Food Tech Frontier is proudly supported by Redstick Ventures, BDC, and MNP. And to learn more about this program and apply, check out the programs page on our website and see the chat. We're going to drop the link there as well. Last but not least, if you're not a CFIN member yet, make sure that you join our growing community of close to 7,000 food business professionals, and you can keep the discussion going there in the forum. Thanks again for spending your hour with us today, and a huge thank you once again to our speakers, Anne-Marie, Doug, Jasmin, Megan, and Cam. Have a great rest of your day, everybody, and we hope to see you in our next session. Bye, everyone.
Thank you very much.
Thanks, everybody.
Thanks, everyone.
Thanks.